Okay, so I guess the first point with Amazon is consumers are already shopping online, and to the order of say 10 to 15% of online sales. It varies by category. So the real question is Amazon going to accelerate the penetration of people shopping online? Is it going to bring new shoppers online? And we think it will. It will increase that penetration, but probably quite gradually. The first impact that Amazon will have is actually take market share from existing online players, the eBays, the Kogans, and that's the first impact. The second thing is not all countries are the same. We see in countries like Canada, Amazon has been a lot less successful. So they've been more successful where the population is more tightly packed, such as the UK, and obviously they've got home ground advantage in the US. So we do think there's some structural differences in different countries, which means that Amazon will end up with a market share of, say, 5 to 10% in Australia, maybe 5%, but it'll take quite a few years. They might have 50% of the online market, but that's perhaps 5% of the overall retail market. So it definitely will impact the bricks and mortar retailers, and they will need to invest. They'll need to invest in their in-store experience and their service, and they'll need to probably reduce prices. So we have factored that in. But as I said to you, value investing is around identifying the sustainable cash flow of a company, but also identifying what the market's concerns are and whether they've been overly factored into the share price. And we believe the market has overly factored the concerns in. To give you a case in point, the market people often look at the market and say it's on a price earnings multiple of say 15 times or 15 to 20 times. We look at cash flow, which is more relevant. It's what actually pays the dividends. And on a cash flow basis, the market is more like 25 to 30 times cash flow. Cash flow is always less than accounting earnings because accounting earnings are somewhat fabricated or made up by company management sometimes. A lot of these retailers are on 10 to 15 times cash flow, whereas the market overall is on 25 times cash flow. So when you take a cash flow lens, and you also include franking credits, and a lot of them have a lot of franking credits, they look quite cheap relative to the rest of the market, which means that Amazon will have an impact, but we think it's more than factored into their share prices at present. And look, that is a case by case. We don't own all retailers, but it's a more general comment about what's factored in. I guess so you have to look for retailers that obviously have a good customer perception of value. Now perception of value is often different to price, so customers do view Harvey Norman and JB Hi-Fi as generally offering good value. They've got a good value perception. Customers don't feel they're being ripped off, which is positive. They need to make sure they hold on to that perception, because once you lose that perception, as some have, then it's difficult to recover. The other thing you want to look for is the retailers that only mark up their goods by a relatively small amount, which is called the gross margin. So we see, for example, that JB Hi-Fi's gross margin is only around 20%. Now this compares to like discount department stores of say 40% gross profit. And then you want to look for companies that have a low cost of doing business, so relatively low rents, quite efficient with their labor. And again, we see companies like Harvey Norman and JB Hi-Fi as better placed relative to other players in that market.